So this again is a very common question which a lot of founders will have, to say that I'm embarking on my fundraise process. How do I negotiate valuation with the investor? And how do I, what is the number I should go with? What can I expect? How much can I expect to raise, and what stake should I give up for it, right? This is a very, very, sort of subjective question to answer. Valuation is an art. I would say more of an art than a science. The earlier you are in your stage of evolution and the more early stage of a company you are, the more of an art it becomes, and less of a science it actually becomes. So there are several intangible factors which go into determining the valuation of the company. Especially if you're an early stage company, you may not have a lot of financial metrics or maybe even business metrics to showcase to investors. In which case, investors need to take a call on investing in the business and need to take a call on valuation based on their own view and their own conviction on the business, the strength of your business model, the way you articulate it to your investors, the strength of the founding and the management team in the company at this stage, and whatever traction, whatever progress you're able to showcase to the investors. So investors do look for a certain set of metrics. And it's important for founders to understand what are the metrics which will drive valuation. If you are running, if you have a running business and you have financial metrics to showcase, revenue, maybe even profitability, those could be metrics which can drive valuation. Or if not, if you're an early stage company, it could be user traction, user feedback, things like NPS, which could actually play a role in determining the valuation of it. How does one actually go by in terms of determining a value or placing a value to the company, and therefore asking for the stake which the investors will ask for? There are a few methods. The most common, most suited for, I would say, early stage startups would be the precedent transactions method. Looking at all transactions, funding transactions, or maybe even strategic transactions which have happened in that industry, of companies which are similar to your company in terms of business model, or of companies which are in the same sort of domain. Looking at those multiples, and when I talk about multiple, you will show the valuation as against a certain metric. It could be, let's say, your price to sales, where you represent valuation as a multiple of sales, or it could be a multiple of, let's say, the number of users you have, or any other metric which may represent traction. So understanding what multiple people typically look for in that industry, and sort of benchmarking yourself against other sort of peers or other competitors in that space may give you a sense of your own valuation or what investors may be looking for when they let's say are making you an offer. If you are in a space which has listed companies, it's a lot easier to actually get a sense of valuation metrics, at least with respect to financial sort of multiples, price to sales, or price to enterprise value to EBITDA, or price to earnings. So you look at the companies which are listed, and typically information is publicly available. You'll be able to go and pull these multiples and benchmark yourself against them. A third and not so common sort of means of valuation, more suited for stable companies with predictable cash flows, but may also be used, if not as a primary method of valuation, to triangulate the valuation, which may come from the other two methods, is a discounted cash flow, or the DCF method. Basically, you project the performance of the company and the cash flows of the company into the future, and you make a very financial argument to sort of discount it based on a certain discount rate, arrive at a certain value today, and tell the investor, this is what I believe you should be paying me, because this is what I expect to generate in terms of cash flows in the future. Again, it's not as much suited for early stage companies, because it's very difficult to actually project your performance, especially cash flows, if you are actually just setting up the business. What are a few guidelines for founders as they negotiate valuation, or as they think through and come up with a valuation ask for investors? Please do research precedent transactions in the space. Have an understanding of who your peers are, who your competitors are. Have an understanding of which of them have raised funding, and the terms on which they have sort of raised funding. So public information is available to some extent. If not, conversations with investors, conversation with other peers may give you a sense of what terms they got, and you can use that as an anchor to ask for terms from your perspective when you speak to investors. Also, it's critical to understand what investors look for in terms of metrics. Like I said, it is very difficult and it's very subjective to place a value on early stage companies. But to understand that, okay, I should get to, let's say, a proof of concept stage. I should demonstrate product market fit. I should hit the market. I should show geographical expansion. And for each of these stages, the risk which is perceived by the investor may decrease, and thereby he might be willing to give me a higher valuation. So to really understand what investors look for, so it's very critical for founders to ask for feedback from investors. What do you really want to look for, which will convince you to invest in this company and which will convince you to give me the valuation set? Another critical element which founders sometimes may not really consider is that the investors coming in, and we're talking about financial investors whose business model is to enter companies, scale it up, and make a return upon their exit. So the valuation ask which founders have should result in an exit, an exit which gives the investor at least their benchmark return or their target return, and actually more than that, given the risk in the company. So as a business, are you confident of scaling up to a point over the next 3 years or 5 years or whatever the investment horizon for your investor is, to a point where your investor actually gets a target return? Many times it is possible for you to have a very high expectation of valuation, but the metrics and your business plan itself, even at a plan level, may not really showcase a traction which results in a higher valuation, which may give the investor the exit which he sort of wants. So it's critical to understand that, okay, if I'm asking an investor for a certain valuation, if I'm going to give him a certain stake for the quantum he's giving it to me, can I actually give him a good exit? And does my business plan and projection actually get him to that stage at an exit which is attractive for him?
Revolutionize your startup's equity management with Qapita. Request a demo today.